With some question marks hanging over some of the more traditionally popular domestic share sectors, such as the banks, allocations to global equities have gained more prominence recently. Joining me today is Pieter Fourie from Sanlam to discuss this issue. Welcome, Peter.
Good evening.
Well, I think we might start just by discussing what some of the current market conditions are in global markets and some of the opportunities that are being presented there.
This year's been quite interesting. Unlike the previous few years, the US stock market's actually underperformed. A lot of fundamentalists feel that the US market, being the most expensive market in the world, that time was right for the US market probably to lag the likes of Europe and Asia. We've seen that happen this year. And unfortunately enough for us, we have been buying towards the back end of last year a few companies like Baidu and Yum China. Even though they listed in the US, they do their business in Asia. So we've been quite fortunate that those businesses have performed very well for us. It does, however, leave us with a bit of a short-term conundrum. If things like Baidu and Yum China move up by more than 35 to 40%, it does move it very closer, if not to an overvalued territory versus our value of intrinsic value. So we have taken profits in some of the names that have performed very well for us this year.
Okay, so in light of some of those factors, maybe you can tell us a little bit about the principles behind the Sanlam Global High Quality Fund that you offer.
Yes, we operate on the basis that we want to find great businesses. Typically they will have a wide economic moat, and typically they would have the ability to grow for many decades, if not for 50 to 100 years, by being very much in charge of their own destiny. What do we mean by that? Because of their wide economic moat, they have pricing power. Pricing power is very important in a deflationary world that we live in. And typically we would therefore seek businesses that are not in commoditized areas like financials, mining stocks, utilities, etc. And we end up with businesses that typically trade at slightly higher valuations in the market, but not at excessive valuations. And we do have the ability to sell out of names sporadically if that opportunity exists. And we feel that our 125 name universe give us enough opportunity to dynamically switch between different stocks.
Now you mentioned a couple of stocks right at the start, but maybe you can give us a bit of a picture as to how the fund has been positioned over the last, say, 3 to 5 years.
Okay. Well, we haven't had a great opportunity to invest in names like the healthcare division, for instance. Those sectors traditionally have been quite expensive. But that is an area that lately, over the last year, we have been increasing our allocation to that. One of our top positions is Medtronic, one of the world's leading medical equipment companies. That's an area we favor. We do have the odd drug company, but we try and not overexpose the fund to that because we feel the business-specific risk could be quite high in companies which focus only on a few core products. Traditionally, we have favored consumer goods companies quite a bit. Unfortunately, lately they have become expensive, so we've taken the position size down in names like Nestle. And having said that, though, we also find that names like Reckitt Benckiser, which are competitors to Unilever and Procter & Gamble, have lately become an interesting proposition for us, and we're just building a position in that. Unlike the 2000s period where technology stocks were trading at super high valuations, that is an area that we have quite big exposure as well. So names like Alphabet, Microsoft and Oracle feature for us, but we find it very difficult to get ourselves comfortable with the valuations that names like Facebook, Amazon and Netflix are trading at the moment.
Now, are there any sectors that you deliberately avoid?
Those sectors that are over-regulated tends to scare us away. Utilities is one that come up in my mind. Another sector that typically we would avoid is financials, banks in particular. Our whole process is driven around return on invested capital, but we're looking for business that can do high return or achieve high return on invested capital without a lot of excessive gearing. So your typical bank would be 8 to 12 times geared loans versus deposits. So if we can find a business like a Johnson & Johnson that does 20% return on capital with very small amount of gearing, that to us is much more preferred than investing in a typical European bank, which might be up to 30 times geared in the case of Deutsche Bank.
Okay. Now you mentioned our 125 stock universe a little bit earlier. Are you limited to the number of stocks that you like to hold ideally within the portfolio at any one time?
We try and stick to 25 to 35 names. I mean, at the moment, the fund is towards the maximum end of that range. It's an admittance that within quality sectors, it's very difficult to find disparities between sectors within the same universe today. However, we're quite comfortable that volatility on a stock-specific level can be quite higher than an index on its own. So we feel comfortable that the opportunities will come for us if we stick to what we're doing. And typically our 125 names that we look at don't change that much. We believe that great businesses actually are hard to find. New businesses certainly don't come around. You know, it's easy with the benefit of hindsight to say that Facebook would have been a big business and a great performer 10 years ago, but investors underestimated at that point in time the ultimate earnings power of those businesses. And if we could find that type of name, it's always a real kicker for the fund. A name that we've discovered over the last few years would be a company like NetEase, which does focus on mobile gaming. Earnings powers of that business has been quite tremendous and vastly underrated by investors over time.
Now, Peter, you mentioned valuations several times there. What's your current take on valuations in the markets that you participate in, and how do you manage that sort of risk?
Yeah. I think we can't deny the fact that if you look at median valuations in the US, it's really, it's not 2000 levels, but it's really pushing towards the upper end of the valuation range. What we do find, however, is that you don't have the stratospheric valuations in areas like technology that we had in 2000. So even though Microsoft might be on 18 times earnings next year to the end of June for their fiscal year end, that is much, much less than the 45 or 50 times earnings that are traded at back in 2000. So we never want to anchor ourselves to previous valuations, which was in bubble territory. But that's a good example of a stock that offers us a 5 to 6% free cash flow yield. It's very compelling. Yes, it is in technology, but we still feel there's upside, and we certainly don't look at energy stocks at this stage. They already discount quite a large earnings recovery. The energy sector in the US is trading on 30 times earnings and probably at quite depressed earnings levels, but we'd rather invest in those businesses that we understand and which do still trade at a discount to the market.
Yeah, yeah. And so if a retail investor was looking to have an allocation to the Sanlam Global High Quality Fund, what can they expect? Well, when I joined Sanlam 5 years ago, I was of the opinion that given where starting valuations are for high quality businesses and the fact that earnings growth still looks quite rosy going forward 5 years ago, that you could expect sort of 12% per annum dollar returns. That's what we actually delivered over time, and it significantly beat the market over that period. Going forward, I think the market is in a 4 to 6% return range, and we are hoping that we can do a little bit better than that. But I think investors have to accept the fact, and we have to accept the fact, that it will be a low return environment, because for our businesses, earnings still look quite robust, but the valuations are unfortunately a little bit higher than 3 to 5 years ago. Okay. And a final question, do you manage currency risk or anything like that within the fund?
Last year, for the cash that we did have in the fund, we favoured the US dollar. It's worked in our favour last year. The dollar was mostly up against most currencies. This year, it's not working in our favour. Having said that, though, a weak dollar is a big beneficiary for many of our US names, whether it's a Philip Morris or Procter & Gamble, and that's really softened the blow, so to speak, for holding dollar cash. I think going forward, I still prefer the dollar long term. I'm quite surprised by how strong the euro is. The euro strength this year is also putting pressure on earnings growth for European companies that operate internationally, and you're starting to see the likes of Pernod Ricard last week just notifying the market in their results that the growth will perhaps not be as strong as they forecasted before because the dollar is very weak, and therefore it's putting pressure on their earnings as they reported in euros. So we still think that in the very long term we want to have a dollar cash, but we don't hedge any of our positions ourselves. We feel that the underlying earnings growth of our businesses will ultimately be reflected in either currency strength or currency weakness, depending on where they do business. Net, if emerging market currencies remain relatively robust, that should be good for our companies. About 25% of their earnings come from emerging markets.
Okay, fantastic. Well, thank you very much for the discussion and for joining us this afternoon, Peter.
Thank you.